I'm Maria Minniti. I'm a professor in the Department of Entrepreneurship, Entrepreneurship and Emerging Enterprise and the Louis Bantel Chair in Entrepreneurship and Public Policy at the Whitman School of Management. In 1990, thanks to a generous gift, the Louis Bantel Chairs were established at Syracuse University. The purpose of these endowed chairs is to provide for teaching and thought leadership in entrepreneurship, business, and government policy. One chair resides at Whitman, and as I mentioned, I have the privilege of occupying it. The other chair resides at the Maxwell School and is currently occupied by my colleague, David Van Slyke, who's professor of public administration and Louis Bantel chair in business and government policy in the Department of Public Administration here at Maxwell. This symposium is a joint initiative of Whitman and the Maxwell School. The goal is to foster synergies across the two colleges and to facilitate the discussion of important issues that are relevant to business and government. Today, we welcome at SU Professor Larry White from George Mason University, and we are honored to have him as our speaker at the first Bantel Symposium. Larry White is Professor of Economics at George Mason University. He specializes in the theory and history of banking and money, and is best known for his work on free banking. Indeed, Larry White is one of the original architects of the modern theory of free banking, which has grown significantly in importance since he started working in this, in his dissertation. Larry received his bachelor's degree from Harvard University and his MA and PhD from UCLA, where he studied with Axel Leyenfeld. He previously taught at New York University, the University of Georgia, the University of Missouri, St. Louis. Professor White has published several books, among them The Clash of Economics Idea, published by Cambridge University Press in 2012, The Theory of Monetary Institution, published by Blackwell, Free Banking in Britain, there are two editions published by the Institute of Economic Affairs and Cambridge University Press, and Competition and Currency from New York University Press. He's the editor of Frederick Hayek, The Pure Theory of Capital, The History of Gold and Silver, Free Banking, which is a 3-volume set, and The Crisis in American Banking, and several other volumes. Professor White has published also several dozen articles in top journals. For example, his articles on monetary theory and banking history have appeared in the American Economic Review, the Journal of Economic Literature, the Journal of Money, Credit and Banking, and Economic Inquiry. He has also published a ton of other stuff. The list was several pages long, way too much stuff for me to cover it. In 2008, Professor White received the Distinguished Scholar Award of the Association for Private Enterprise Education. He has been a visiting professor at Queen's University in Belfast, visiting fellow at the Australian National University, visiting research fellow and lecturer at the American Institute for Economic Research, visiting lecturer at the Swiss National Bank, and a visiting scholar at the Federal Reserve Bank in Atlanta. Professor White has also a very prominent editorial profile. He co-edits a book series for Routledge called Foundations of the Market Economy. He's a co-editor of the Econ Journal Watch and hosts bi-monthly podcast for EJW Audio. He's a member of the board of associate editors of the Review of Austrian Economics, a member of the editorial board of the Cato Journal, and is also a contributing editor to the Foundation for Economic Education's magazine and lecturer at the Foundation's annual seminar in Advanced Austrian Economics. Finally, Professor White is a member of the Academic Advisory Council of the Institute of Economic Affairs. To conclude, I would like to spend just a few words to describe his last book entitled The Clash of Economic Ideas, again published by Cambridge University Press in 2012. In this book, Dr. White interweaves the economic history of the last 100 years with the history of economic doctrines to understand how contrasting economic ideas have originated and developed over time. The book offers a fresh perspective on laissez-faire, socialism, and fascism, on the roaring 20s business cycle theory and the Great Depression, on the Keynesian Revolution, the war, and central planning. After 1945, the book also explores the post-war revival of invisible hand ideas, economic development and growth, the gold standard, the post-war Bretton Woods system, free trade versus protectionism, and finally, fiscal policy and public debt. So it's a very comprehensive analysis. The book is already considered a classic, and by the way, it's got 4.5 stars out of 5 on Amazon reviews. I know because I checked. By contrast, Thomas Piketty's Capital in the 21st Century's got only 4. And just to give a measure, even the Harry Potter series lags behind with only 4.4 stars. So I think you made it. The title of today's talk is Can the Banking System Regulate Itself? Is Government Regulation an Improvement over Laissez-Faire? Please join me in welcoming Professor Larry White.
Thank you, Maria. You know, of course, that those Amazon ratings are based on very small samples. It's a pleasure to be here. I was a little puzzled when I was invited to speak between 10 a.m. and noon. But why so early? And then watching TV last night on CBS, I learned the tip-off is at 12:10 today for the first game in the round of 64, 32, I don't know, whatever we're at. So the big question I want to address is, can the banking system regulate itself? And why not? I mean, let's look at the pros and cons of that proposition. I think it can. I think it can certainly more than it's allowed to now, meaning we certainly need to move in the direction of greater market discipline. I'm not saying that market regulation is perfect in the sense that no bank will ever make any mistakes. That's too much to hope for. The question, of course, though, is whether it's better than the alternative. That's the way economists always think about things. What's the alternative? So I'm going to try to state fairly and identify the problems in the self-regulation view and in the contrary view that government regulation is an improvement over laissez-faire in banking. Now, my position on the laissez-faire side is a minority view among people who study banking regulation. So I don't expect to persuade everyone entirely this morning, but maybe I can nudge you in the direction of greater market discipline. I understand Paul Volcker was here yesterday. It would have been great if he had stopped in this morning. We could have had some interesting discussion. I actually think of the Volcker Rule as an attempt to undo some of the perversities caused not by laissez-faire in banking, but by our current regulatory regime. So I'm going to try to help at least alert you to some of the problems of our current regime that you might not have been fully aware of, and some of the self-regulatory mechanisms you might not have known about. And so if I'm going to talk crazy, I hope at least it's interesting crazy. I like to think of the case for free banking as very much parallel to the case for free international trade. I like to do that because that's pretty uncontroversial. I mean, most economists certainly think that international trade ought to be free from legal restrictions. It's pretty much a consensus view. I'm going to take it for granted that that's correct. That protectionism and mercantilism are mistaken views. That banking ought to be free is not so much a common view, even though at the beginnings of economics as a discipline, and I'm sort of drawing on the book that Maria just mentioned, Adam Smith thought that banking should be pretty much free from legal restrictions. He endorsed 2 minor restrictions on the issue of banknotes, but he didn't propose any restrictions on deposit banking, and enunciated a theory according to which it could regulate itself. Not a perfect theory. We've improved on it since then, but he had a lot of respectable supporters in the 19th century on this view. And they developed a theory of how the banking system regulates itself, how there are built-in checks and balances against any bank sort of going wild. And there were big debates when proposals were made to establish government oversight, to establish central banks. There were big debates over that. There were arguments on both sides. We don't hear those debates anymore. Central banking is taken for granted. And likewise, deposit insurance. So I'm not actually going to talk much about central banking, but about deposit insurance, which I think is the most important regulation in the banking system today. But it's seldom debated except around the margins. Whereas once upon a time, laissez-faire in deposit banking was almost universally accepted, and the idea was depositors could look out for themselves, caveat emptor. So where does the case for government regulation or intervention come from? On the face of it, banking services are private goods, so it's not clear where the public goods problem is. If you want to rebut the argument that the invisible hand operates here, to make a case for government doing more than enforcing laws against theft and fraud, you have to show that it's prone to market failure, right? That's the standard way we conduct these arguments. So I want to go into those arguments, but before we talk about the historical evidence, but before we do that, or to use my favorite NPR phrase, before we drill down into the historical cases, I want to make this sort of methodological point that to understand regulation, to understand the difference it makes for good or for ill, we need to understand what the banking system would look like without it. We need to have a model of free banking as a baseline. Just as to understand the difference that tariffs make or quantitative restrictions on trade, we need a baseline model of what free trade looks like. Now, of course, it's true that we've had a long history of banking regulation in the United States from the very beginning. That isn't because laissez-faire was tried and found wanting. It was hardly tried, but I'm going to argue that in the cases where we came closest to trying it, where banking was least regulated, the results were actually the most successful among different types and experiments with banking systems in U.S. history. So the fact that it's long been regulated shouldn't be taken as evidence that we needed regulation any more than the fact that we have tariffs and trade barriers is evidence that those are good things, right? We understand that tariffs and trade barriers are harmful to the public interest and that they're motivated either by revenue concerns or by special interests who are protected by tariffs, kind of rent-seeking motive. We can understand many bank regulations the same way. So that's kind of the landscape. But if we talk about at a purely theoretical level, we're not going to really resolve the issues because we've got theories according to which markets regulate themselves, and we've got theories of market failure. And so just pure armchair theorizing isn't going to resolve that. We need to look at historical cases. And when we do, here's my sort of broad brush. I'll give you some more details shortly. But the broad brush record is that less restricted banking systems around the world, across history, systems closer to laissez-faire, I can't claim I can identify one that is laissez-faire, exhibit greater efficiency and greater stability. That's the part that often surprises people. It's not clear that there are market failures evident that regulation needs to remedy. So we need to look at the actual track record of banking systems as close to laissez-faire as we can find. And correspondingly, when we look at the impact that bank regulation makes, we need to look at the actual track record, not just how the imagined efficiency gain looks on the blackboard. Okay, so that's enough preamble. Let me talk about what you should know about free banking history. And here I'm drawing on a chapter I recently published in a book entitled Renewing the Search for a Monetary Constitution. It's available free as a PDF download on the Cato Institute site. Well, if it's not currently, it will be soon. Probably shouldn't say that. No, I've already been paid my royalties. Okay, so when I say banking systems that are less restricted, I also mean banking systems that are less privileged, because a lot of the legal intervention in banking systems has not been to hamper banking, but rather to enrich bankers. So systems close to laissez-faire have lower entry barriers, activity restrictions, geographic restrictions, restrictions on branching across county lines and state lines have been a big part of U.S. banking history, and fewer pricing restrictions. No monopoly privileges, no taxpayer rescues or backing or bailouts. So, as Maria mentioned, my dissertation research was on the debate over free banking in Britain, and in particular, one chapter is on the history of the free banking system in Scotland. And that's interesting because it was an especially long and lightly regulated system. But it's not the only piece of evidence we have. There are literally dozens of other cases. A student of mine wrote a paper modestly titled "The World History of Free Banking," in which he identified about a little more than 60 cases of places that had systems of multiple issuers of banknotes, no central bank, minimal restrictions, no lender of last resort. Now, they differed from current day systems not only in having privately issued currency, but also in having gold or silver standards be the basic money. I mean, that's how you can have a monetary system without a central bank. The quantity of money is regulated by the price specie flow mechanism, by the supply and demand for gold and the gold mining industry and arbitrage. That's all part of Adam Smith's critique of the mercantilist idea that you needed to hoard money. The quantity of gold in your country will regulate itself, and by extension, the quantity of money issued by banks regulates itself. But I want to talk more about the bank regulatory side rather than the monetary side. The relatively well-studied episodes besides Scotland include New England, so that's the closest one to home. Canada, it's not that far. Which way is north? Sweden, Switzerland, Chile, Australia, lots of big economies. There are still 3 places in the world that have sort of the remnants of this in the form of private note issue, and that's Scotland, Northern Ireland, and Hong Kong. I was once giving a talk to a group of Chinese officials, and I said, there are 3 countries that still have private note issue, and they immediately, Hong Kong is not a country. It's a special autonomous region. Okay, 3 places. So what we find in these systems that I'm calling free banking systems, compared with more restricted systems where either banks were given monopoly privileges or there were branching restrictions or other kinds of restrictions, again, this is painting with a broad brush, we find a greater record of innovation, improvement, success at serving the users of banking services. So the Scottish system was known in the 19th century as the most innovative banking system. They developed all kinds of improvements that I'll mention later. And they sent bankers around the world to teach other people how to conduct banking systems. So a lot of the early banks in Canada are founded by Scottish bankers because they were at the forefront of the industry. And probably most importantly, there were fewer banking crises in these places compared with places that restricted banks. And it's actually not that surprising when you see how the restrictions worked. In England, banks were restricted in the number of partners they could have, which meant they couldn't have enough capital to be well capitalized. They couldn't have enough capital to be widely branched and therefore geographically diversified. Whereas in Scotland, banks could have as much capital as they wanted. So let me drill down into 3 cases, Scotland, New England, and Canada. So in Scotland, you had a system where there were 3 banks that had charters, which gave them limited liability, and for many decades, those were the largest banks in the system. But entry was free. Anybody could start a bank on the basis of unlimited liability, so legally, basically a partnership, but with tradable shares. And after about 1800, 1810, lots of large joint stock banks began to form. And so in the heyday of the system, say around 1825, you find a system where there are many large banks, but none of them disproportionately large. So there are economies of scale, but there's no natural monopoly. All the large banks are extensively branched throughout the country. And although they're all issuing their own currency notes, all these notes are trading at 1-to-1 against each other. So no different than today, a check from one bank is accepted at 100 cents on the dollar by another bank. So there's no confusion created by multiple units of account. Everybody's on the pound standard, and the liabilities are trading at par. And they're trading at par because it's in the bank's interest. You attract more customers that way if you can get your liabilities to trade at par. It's a very competitive system. If you measure the spread between the interest rate charged on loans and the interest rate paid on deposits, it's very small. It's like 1.5% most of the time. As I mentioned, it's a very innovative system. Scotland is where branch banking develops for the first time. They invent the overdraft. They invent, well, they don't invent, but they popularize interest on checking accounts. They pioneer mutual par acceptance, and the first important bank clearinghouse in the world is in Edinburgh. They have a lower failure rate than the banks in the English countryside because, as I said, those are undercapitalized. Now, in England, by contrast, you have the Bank of England, which has privileges which make it the only large bank in London, the only bank allowed to issue notes in London, and that's a major source of bank funding in those days. So you got this one big solid bank, but it doesn't behave very competitively. It doesn't pay interest on its checking accounts. And then in the countryside, you have lots of little competing banks, but they're not very solid. Whereas in Scotland, you have banks that are large and solid and competitive. There's one important crisis in the Scottish system. It happens in 1772. It's described by Adam Smith in The Wealth of Nations. It's a failure of an appropriately named bank. It's called the Ayr Bank. It's A-Y-R, but still. It was run by people who had enthusiastic ideas about how to run a bank, but they didn't really know what they were doing. They managed to grow to be a large share of the system, something like 25%. So when that crashed, that was a major event. But it didn't pull down the other banks. It pulled down a few tiny banks, but not any of the other large banks. The system recovered very quickly. And the other bankers actually financed a study to what went wrong in the Ayr Bank, and that became a kind of manual for what not to do. So in a way, the failure of the Ayr Bank actually improved the banking system. Other banks learned to avoid those kind of mistakes. There's a recent dissertation out of Harvard by an economist named Tyler Beck Goodspeed. This will be his second book. It's a fast study, but it's about the Scottish banking system, and in particular about how the system showed resilience in the face of the Ayr Bank failure. So it was a robust system. Part of the robustness, part of the credit for the robustness, goes to the unlimited liability that I mentioned, except for the three chartered banks. Unlimited liability meant that the shareholders in the Ayr Bank and in any other bank failure had to pay back all the depositors. They didn't just walk away and say, well, my shares have gone to zero. They got letters saying, here are the unpaid debts of the bank on a pro rata basis. Here it is per share. You have this many shares. Here's what you have to chip in. And this was such a large failure that estimates are something like 2/3 of the land in Ayrshire had to change hands before the major shareholders were done paying, but they paid. So the depositors then had no reason to panic when they heard a bank was in trouble because they knew they would get paid as long as the shareholders had any net worth left. So that's a kind of remarkable way, and it constrains, of course, the incentives of the shareholders, in directing the managers of the bank. Unlike a system where the bank fails, that's the end of your obligation. In a system like that, when the bank's net worth gets close to zero, you have less and less to lose by encouraging the bank to start taking crazy risks. And we saw that in the US during the savings and loan crisis. But here, you still have something to lose. The deeper in the red the bank gets, the deeper in the red each shareholder gets. So you actually had a remarkable phenomenon in these systems with unlimited liability, or even extended liability, double or triple liability is enough. People would close banks without defaulting. You never see that anymore, right? People keep the bank open as long as they can until the authorities close them. But in this case, if the bank's unprofitable, you give everybody their money back and say, take it somewhere else. We've discovered we can't make a profit. And nobody fails to get paid. So that speaks to a different incentive system.
Excuse me, sir.
Yeah.
Could I just ask you one question? Would help, certainly me understand. What was the situation as regards the bank notes and the deposits as regards gold? Were these backed and liabilities in terms of specie?
Yeah. So the basic money in the system is gold or silver. You could redeem the notes at the office of the bank. People very seldom wanted gold coins or silver coins. It was much more convenient to deal in banknotes and bank deposits. The Scottish banks had arrangements with London that they could have gold shipped up if they needed it. Okay, that's one way to reassure depositors. I'll talk about some other ways to do that in the absence of deposit insurance. In New England, well, if you look at the U.S. as a whole, it's a mess. There are 50 different state banking systems because banking is regulated by state governments before the Civil War. New England was the best of the systems, and I say New England because the system was unified by a bank in Boston called the Suffolk Bank, which developed a clearinghouse for notes and checks that made them all throughout New England, at least all the banks that participated, trade at par, at face value, at 1-to-1. So the Suffolk Bank did this as a business. It turns out that's kind of not a sustainable model. Other banks figured out that they were paying a lot for the clearing services that the Suffolk was providing, and so they organized their own bank to do it, called the Bank for Mutual Redemption, which was a member-owned cooperative. And that's been the model for bank clearinghouses ever since. So there are economies of scale in clearing, but it's not going to exploit the banks that use it because they're going to own the clearinghouse. Anyway, the banks in New England were much more solid than in other parts of the country. When the War of 1812 came, banks suspended payments everywhere else in the U.S., not in New England. Part of the reason is that people in New England didn't like the War of 1812. Anyway, so that was the big success story, and it was a success story, I think, because entry was most free in New England. It was a chartering system, but the legislatures would give out charters pretty freely. Now, there was a movement in other states to allow more freedom of entry, and it became known as the free banking movement, and states enacted what were called free banking laws. But if you can see my text here, it's in sneer quotes, free banking, because it wasn't the same as Scottish free banking, meaning it wasn't close to Laissez Faire. It was a system in which, unlike having to go to the legislature to get a charter, anybody could get a charter. This was the forerunner, by the way, of general incorporation laws. It used to be you had to go to the legislature to become incorporated. After reforms in the 1840s, anybody could just fill out the paperwork and become incorporated. This is the forerunner of that. So anybody can get a bank charter, but there are strict rules on what you have to do to qualify for the charter. In particular, there are still restrictions on branching. Your charter is just good for one office, typically. And there are collateral restrictions on note issue, meaning states looked at this and said, well, let's see, we're running deficits. Who can we get to buy our debt? We can sell a certain amount in London, but we'd like to borrow even more than that. Let's get the banks to lend us money. They've got money. Right? You all know Willie Sutton robbed banks because that's where the money is. So the deal was, if a bank wanted to issue banknotes, it had to buy state government debt in equal amount or in 100%, 110% of the amount of notes they wanted to issue. And then they would give those assets to the state comptroller of the currency, and it would be held as a potential redemption fund. So that's why I say collateral. If the bank failed, the note holders would be paid back by selling off the state bonds. But that was a restriction because it meant the bank couldn't flexibly change the amount of notes it had in circulation unless it went and got more collateral, and it couldn't shrink it unless it reclaimed the collateral, which was cumbersome. But there was a fiscal motive in it, at least for the states that said you had to buy our debt. Some states were more liberal and said you could buy debt of other states. The person who's done the most important research on this is an economic historian named Hugh Rockoff, who's at Rutgers. And Rockoff has emphasized that these restrictions were fairly heavy, so you shouldn't make the mistake of thinking free banking in the United States means laissez-faire banking. Rockoff studied why it was more successful in some states than in others. So some states had problems with clusters of bank failures. And what he discovered was that it was a problem in the collateral law. In some states, they under-collateralized the issue of banknotes. That is, they gave the bank credit for the par value of the state debt, even when the bank could buy it for less. So this was like a money-making machine. You can buy collateral for $80, use it as the basis for issuing $100 in banknotes. Well, now you can buy another $100 of state debt, use that as the basis for issuing $120 in banknotes, and so on. And if the banknotes are easy to get into circulation because everybody knows that the state is backing them up, then you buy as many assets as you can and abscond. So that was the problem in states that had poorly formulated collateral laws. In states that didn't do that, it was pretty successful. And New York was one of the more successful. This is where it began, in New York State. One of the more successful examples, and it spread to other states. I mean, it wouldn't have spread if it hadn't been successful. By the Civil War, so in New York State it's 1837. By the Civil War, more than half the states have adopted this kind of system. Now, in some places it worked very badly because of the way the regulations were written. So in Wisconsin, about 3/4 of the banks failed in 1860. Why is that? Because the regulations in Wisconsin said you get collateral credit for the par value, the face value of the bonds you deposit, and you can buy bonds from any state as collateral. So the bank said, well, where can I buy the cheapest state bonds? Missouri. Missouri bonds were selling at about 50 cents on the dollar. Well, there's a reason, right? Because the Civil War was coming and Missouri was going to break up. So the bond market was already predicting that. They were putting about a 50-50 chance on these bonds being paid back. So you get them at 50 cents on the dollar. You get credit for issuing $100 worth of banknotes. Now you can sort of freely finance another $50 worth of assets. So the banks in Wisconsin were completely stocked up with state of Missouri bonds. Their portfolio was completely undiversified. That's what they were doing. And when the Civil War came and the state of Missouri broke in two, the bonds fell nearly to zero in value. 3/4 of the banks failed because their assets had fallen in value. So that was not a failure of laissez-faire banking. That was a failure of a poorly designed regulatory system. The other thing you hear about American free banking experience are stories about wildcat banking. And they're very popular in money and banking textbooks because they're colorful, right? So wildcat banking is the idea that wildcats live out in the woods. You start a bank and issue banknotes and get them into circulation, and now you've got the means to buy assets which you can abscond with. And when people come looking for your bank to redeem the notes, they can't find it because you're out in the woods somewhere. There were 1 or 2 cases of that, but it was not as common as some of the histories would lead you to believe. All right. During the Civil War, the federal government, or as I learned to call it while I was teaching at the University of Georgia, the Union government first enters banking regulation, and they do it for the same reason the states do, to raise revenue. So the National Banking Acts say the following: we need to sell somebody our bonds. The states do it by selling them to banks. We can do that. So for the first time, the federal government says we will charter banks. And if you want a federal charter, the condition is you got to buy federal debt. You got to buy a certain amount before you get the charter, and then you have to hold federal debt in proportion to the number of notes we're going to let you issue. So you submit the bonds to the federal comptroller of the currency, and they send you the blank banknotes. Just add your name of your bank to the note and sign it, and it's off in circulation. I said I wasn't going to talk about monetary policy, but if we could reinstitute the rule that every currency note had to be signed, that would be a way of limiting inflation. That's a joke. So it's called national banking, but the bank charter, the federal charter, doesn't allow you to bank nationwide. You're still limited to the state in which you are chartered. And the bond collateral system as a restriction on note issue now becomes very important. Oh, by the way, the National Bank Regulatory Office is still called the Office of the Comptroller of the Currency, even though national banks stopped issuing currency in the 1930s. So what is it now, 80 years later? Someday they'll get around to changing the name of the office. Probably around the time the Fed redraws the map that they drew in 1914 of Federal Reserve districts. Anyway, it's clearly a fiscal measure, although it was sold as a way of creating a uniform national currency. That was pretty much window dressing. The branching restrictions remain, and the problem with the collateral restrictions is that it makes the supply of currency inelastic. And this is a problem that we don't really have today, so you have to sort of put yourself in the 19th century to understand it. But there's a big seasonal swing in the demand for currency as opposed to deposit balances. And the reason is that farmhands are paid in currency. They don't have checking accounts. Most people don't have checking accounts. Most workers are paid with an envelope stuffed with banknotes. The farmhands are typically paid in the fall, so that's a lot of money. The farmer goes to the bank and says, I need currency to pay my farmhands. And the bank says, I'm not allowed to issue any more currency. I'm up to my limit. And the farmer says, okay, you can't issue new banknotes, but I'll take whatever you've got in your vault that looks like currency. I'll take gold certificates, silver certificates, greenbacks left over from the Civil War. Those are still in circulation. I'll take gold coins if that's the last thing you got. And now what could have been just a switch from deposit liabilities to currency liabilities, this is the right-hand side of the balance sheet where the liabilities are, as it was in Canada, no problem, now becomes a reserve drain. Here are the reserves over on the asset side. So the reserves are running out, and now the country bank has a reserve drain. That's a problem. They're going to run out of the ability to meet their obligations if they run out of reserves. So what do? Well, some of their reserves they hold as deposits in other banks in the city, because the city banks have more investment opportunities than they do. And they get interest on these deposits, and yet they're counted as legal reserves. So they call on their reserves in the city banks, and now the city banks have a reserve drain. What do? They start pulling reserves out of New York. Now New York has a problem. And that's basically the story of the panics under the national banking era. 1873, 1893, 1907. Actually, 1907 went the reverse order. There was a panic in New York first, and then it spread to the countryside as the country banks learned that they couldn't get their reserves anymore. So that's why we had the panics, and they all happen in the fall, which is the crop moving season when farmers are demanding currency. So a currency famine becomes a reserve drain, becomes a problem for the entire system. Everybody trying to borrow reserves, interest rates spike, and in the worst cases, there are suspensions of payments. Banks just stop paying. But those kind of panics, which are the inspiration for the Federal Reserve Act, those are not inherent to banking. That's the point I want to make. And it's pretty obvious if you just look north. Which way is north? If you just look north to Canada, they didn't have any of these panics. They had a very similar economy, mainly wheat growing. That was the main. Most Americans were farmers in 1870, so were most Canadians. The difference is they had a nationwide banking system where if there's a problem just in the farm area, well, there isn't a problem to begin with because there's no collateral restriction. So the farmer goes to the Canadian bank, I need some banknotes, eh? And the banker says, that's fine, I'll just issue some new ones. I have no restriction on that. I'm reducing my other liabilities by drawing down your deposit balance, so I don't lose any reserves. I got the same assets. Everything's fine. If a bank does have a liquidity problem for whatever reason, if, say, customers in some town in Canada want gold, they can get it from the head office in Montreal, so there's sort of management of the reserve needs of the banks, whereas in the US, the banks are trying to grab reserves from each other because they're not allowed to have their own offices in New York. So panics are not inherent to banking, even though if you just looked at US history, you would think so. And I have the suspicion that people who think panics are inherent to banking have only looked at US experience. So Canada is kind of like the Scottish system and the New England system in that it's lightly regulated, doesn't suffer the panics, banks are better diversified geographically, note issue is not restricted by collateral obligations. Here's the most remarkable thing about the Canadian system. There are no bank failures even in the Great Depression. Some banks were unprofitable, some branches were closed, but none of the banks fails. So there's no depositor panic, whereas in the US there are 5 separate contagion episodes. There are 5 separate bank panics between 1930 and 1933. The US got the Federal Reserve Act in 1913 because of the Panic of 1907. Canada didn't have a panic in 1907. Nobody wanted a central bank in Canada. They finally got one in 1935, but the bankers were against it. The Federal Reserve Act became possible when the bankers in New York said, okay, we need help. We want help. Bankers in Canada, even in 1935, were against creating the Bank of Canada, but they were outvoted. The Bank of Canada was created from some combination of nationalism and wishful thinking about how having a central bank could help you out of the Great Depression, although if you looked at countries with central banks, no reason to think that. There's a paper specifically on this question, why did Canada adopt the Bank of Canada Act? And one of the reasons the authors point to, and I take this seriously, is that, this is serious, during the early years of the Depression, there were lots of international meetings among central bankers about what to do, and Canada couldn't send anybody. So they felt left out. That's what they say. All right, so I at least have argued and asserted that nearly unregulated banking worked in practice, but doesn't it have problems in theory? So let's talk about the theoretical critique. And the standard approach in economics is to look for market failures, so look for public goods and externalities. The box labeled market failure in banking is emptier than you might think. As I said, the services that banks provide are private services. It's not like if I borrow money from a bank, it somehow makes more money available to you, or that the checking account I have somehow provides services to you. So at least at first blush, it's not obvious where the spillover effects are. At least at the margin, everybody benefits from having a banking system. But if everybody's participating in the banking system, then it's not clear that it's being underprovided. And if you look more dynamically, as I said, the great innovation in payment techniques have come where banks were freest to be entrepreneurial. Innovations like the introduction of banknotes, transferable deposits that pay interest, transfer by check. In the Middle Ages, you had to meet in person in the banker's office. In the 19th century, the big innovation in payments was payment by telegraph. Right? Remote, instantaneous. Okay, it wasn't wireless. It had a wire. But the banking, instantaneous wire transfer was actually the killer application for the telegraph. That's why telegraphs spread the way they did. There's a kind of popular book on this called The Victorian Internet, which I recommend to you. And now what do we have? Payment by telephone, debit card. The latest one I read about was there are banks now that allow you to make deposit transfers by Twitter. Right? So they're all just ways of signaling to the banker, I want to move money from my account to somebody else's account. And now we're getting cell phone payment systems, although some of those are being introduced by cell phone companies, not by banks. I don't know if you ever saw the Pepsi commercial in which this old guy is fumbling in his pocket for change to use the Pepsi machine, and a sleekly dressed young woman walks up with her cell phone and aims it at the machine, and a Pepsi pops out. We're not quite there yet, but we're getting to the point where you can wave your cell phone near the machine and Pepsi pops out. So there are a lot of arguments about possible market failures, failures to internalize costs in banking. The list of bank regulations we actually have, of course, is very long, and somebody's come up with a rationale for each one of them. But I don't have time to go through all of them, so let me focus on the most important one. And the most important one is the problem of bank runs and panics. All right, so this, I think, is the most important argument as to why you might not want to leave banking unregulated. You're going to have too many runs and panics. So you can break this into three parts, or three claims. Claim one is an unregulated banking system is inherently prone to runs and panics. I'll define those terms in a second. Runs and panics are harmful. And in particular, they have spillover effects. They're not just harmful to the people who are already connected to the bank. And third, there's a kind of regulation that can reduce runs and panics with a benefit that exceeds its cost. Right? That has to be part of the argument. So I'll examine each of those. But the one about runs and panics being harmful, that's the least controversial. The ones I'm going to question are that an unregulated banking system is inherently run prone, and that the appropriate regulation, mostly that's a case for deposit insurance, has benefits greater than its costs. All right, so bank run, as I guess you know, is everybody, not everybody, enough customers are trying to withdraw at the same time to cause a problem for the bank, out of concern that the bank will default if they don't get their money now. And a panic is when there are runs on many banks at the same time. And many is a kind of fuzzy term, and so there are historical disagreements about whether this particular event was a panic in some case, because only some banks were affected and not a lot of banks. So this is the main argument for deposit insurance, but it's also been used to support having a lender of last resort. So the Federal Reserve was supposed to stop panics. During the Great Depression, it was used to rationalize requiring banks to hold more capital, restricting entry, because if we restrict entry, banks will be more profitable. If they're more profitable, they're less likely to fail, therefore fewer runs and panics. So this is kind of cutting off the consumer's nose to preserve their face. It's clearly anti-consumer to limit entry and competition in order to create monopoly profits in banks, but the argument was this is better than having banks fail. Restrictions on deposit interest rates, right? In the Great Depression, we got no interest on checking accounts, regulation Q on savings accounts. The Fed determined how much interest your bank could pay on the theory that this would make the bank safer. If they didn't have to compete so hard for customers, they wouldn't take so many risks. This is like the theory that if you regulate airline fares and keep them high, fewer planes will fall out of the sky. It's actually not true. Planes are falling out of the sky at the same rate now as they were before fare regulation, because airlines have the same incentives to skimp on maintenance now that they had then. So that's reassuring. And of course, deposit insurance, but in recent years, too big to fail policies. Now, it's hard to find people who come out and endorse or defend too big to fail policies in any blanket way, but they defend them when it matters, which is when large banks are pushed to the brink. So the most famous statement or notorious statement that Larry Summers made during the financial crisis was, now is not the time to worry about moral hazard. Now is the time to rescue everybody who needs to be rescued, is what he was saying. So panics are even worse, of course, because now you got many banks subject to runs, plus you have systemic effects. If people are running Bank A and putting their money in Bank B, C, and D, that's bad for Bank A, but the system isn't suffering. If people are running on Bank A, B, C, and D and putting the money under the mattress, now the whole system is contracting. Now, first, so I accept that these are harmful events, but there's a qualification. These are harmful events if the bank was solvent and was run upon anyway. Because if the bank was insolvent, right, if the bank had squandered the depositors' funds, making loans that weren't being paid back or buying assets that had gone sour, that bank ought to be closed. It's wasting money. And it's better to close it sooner rather than later because it'll waste less money. So bank runs at least had this virtue: they closed insolvent banks. A run on an insolvent bank is good. It stops the bleeding. And it has a good incentive effect. The threat of a run keeps banks on their toes. They have to invest in a way that doesn't make the depositors nervous. And before deposit insurance, the main complaint about bankers was not that they were risk lovers, the way it is today, but that they were too conservative. They didn't want to make investments that would tie up their money in such a way that if they were subject to a sudden demand for redemption, they couldn't meet it. So you could not get a 30-year loan at a commercial bank. You had to go to a savings bank. That's why we had thrift institutions. But thrift institutions didn't issue checking accounts. They only issued the kind of deposits that couldn't be run upon. You all remember the famous bank run scene in It's a Wonderful Life. And what does George Bailey tell people? He says, come back in 60 days. That's what your deposit account says. You're not allowed to withdraw it today. Who closes banks under deposit insurance? Well, the FDIC, if they get around to it, when they get around to it. So we have to rely on regulators to close banks promptly, but they've repeatedly failed to do so. And they failed to do so because their incentives are in the other direction. The incentive is to forbear, to hope that the bank recovers, while it continues to squander creditors' wealth, which means eventually they're squandering taxpayers' wealth, because that's who has to pay off the depositors. Now, deposit insurance wasn't so bad when there were a lot of uninsured depositors. And as recently as 2008, 28% of deposits in the US banks were uninsured. They were over the insured deposit limit, above $100,000. Corporate accounts, churches' accounts. People with that kind of money in the bank did pay attention to the risks the bank was taking, and they would shop around. They would either put their money in a safe bank or they would put their money in a bank that was considered too big to fail, meaning everybody would get rescued, even the uninsured deposits. And you can see it in the data that banks that were perceived as risky, like banks in Texas, had to pay higher interest rates to get deposits above the insured limit. But since the spread of too big to fail, and among the institutions that are considered too big to fail, or strategically important is the new phrase, or too connected to fail, you don't have that kind of monitoring by depositors. And so if there's no depositor monitoring, then the management can take whatever risks it wants without losing depositors. Now the only constraint is, will the regulators allow it? So now it's up to the supervisory authorities to contain risk because the market discipline's been removed. So in a sense, we're putting all our eggs in one basket. We're relying heavily just on the regulators because depositors no longer have an incentive to shun risky banks. Back when the insurance limit was $100,000, if you had $1 million that you wanted all guaranteed, you could go to a broker, and the broker would place 10 deposits in the 10 banks that were paying the highest rates. Don't you care what banks they are? Why would you care? They're guaranteed. So the savings and loan fiasco in the 1980s showed us what happens if the regulators are either asleep at the switch, that's the benign interpretation, or are deliberately forbearing, right? So the savings and loans were killed when interest rates rose, and the regulators, the FSLIC, the Federal Savings and Loan Insurance Corporation, said, if we wait, interest rates will come back down and these banks will be okay and we don't have to do anything. Well, what was a $10 billion hole in the balance sheets of the savings and loans through forbearance became $150 billion. That would be $260 billion in current dollars. Because the insolvent institutions, or zombie institutions, as they became known, the living dead, you know what kind of havoc they can wreak. They gamble for recovery. The rational thing to do, if your net worth is zero or negative, the only way the shareholders are going to have a share of something positive is if the bank recovers, and the only way to recover is start gambling at long odds and hope for big payoffs. And that's why you get stories in the 1980s about savings and loans being run by guys in Texas who served their clients champagne out of their cowboy boots. Why this attracts clients, I don't know, but you can understand why the board of directors would hire somebody who is a high roller like that. So the problem with bank runs arises because depositors have imperfect information and they might run on a bank that's solvent, and then it's a tragedy if the bank closes. So that is a problem. But it's a bigger problem if nobody forces insolvent banks to close, which is the problem we've had in recent years. Okay. So now I want to turn to the claim that the system is inherently run-prone. I think to understand that question, we need to ask what triggers a run, or what typically triggers a bank run. And there are two leading theories, and in one form or another you've probably heard them. The first one goes technically by the name of the sunspot theory, or in the literature, the Diamond-Dybvig theory, or you might call it a bubble theory. And that's the idea that I've talked about, well, maybe I haven't. If there's a bank run, how does the bank respond to that? Well, they have to pay the depositors, and as their reserves deplete, what do? They have to sell off their other assets. If their other assets are T-bills, not a problem. If their other assets are loans, problem. Those are hard to sell. Certainly in the days before loans were securitized, that was a problem. So they're illiquid. If you try to sell illiquid assets hastily, you get what are called fire sale losses. You have to take whatever you can get. You try to sell your loan to another bank and they say, you got a loan to Joe's Pizza Parlor and you want me to pay 100 cents on the dollar for it? I don't know Joe's credit worthiness. I'm going to take a deep discount before I'll buy that. So because of that opaqueness, non-transparency of idiosyncratic bank loans, which is what banks specialize in, they've got a problem. So if there's a fire sale, that can turn a solvent bank insolvent. So the run then can be self-justifying. Even if you think the bank is solvent today, if you see other people lining up to run, you don't say, well, that's foolish. You say, I better get into that line. Because if I'm last in line and enough people run the bank and empty it out, I don't get anything back. All right? So that's sometimes called the me first problem. And under that theory, whatever makes you anticipate that other people will run will make you run, because you want to get there first. And if other people are thinking the same way, then whatever that event is will cause a run, even if it's intrinsically irrelevant, even if it has nothing to do with the health of the bank. Hence, the appearance of spots on the sun. It got the sunspot name, by the way, because an economist named William Stanley Jevons had the theory that sunspots cause business cycles. And other economists said, that's ridiculous. That's so ridiculous that we're going to call any theory where the cause is absurd a sunspot theory. Right? But if the absurd cause makes people think that it's relevant, it will become relevant. You see sunspots and you think that makes other people run, then you'd better run. It really does cause runs. So this theory boils down to bank runs occur when people are afraid that other depositors will run. And that could be any time, any place. Banking is inherently fragile under that theory. This is a logically coherent theory, but it doesn't engage with our historical record very well. That's a polite way of saying it. Doesn't seem to explain any actual events. If you look at the historical pattern, runs don't happen randomly. In the US, the panics happen at the beginning of business cycles. They all happen at the beginning of a recession. So the recession has already started. The run is not the cause of the recession. And secondly, runs are not a problem in all banking systems. As I said, Scotland didn't have any problem with banking panics. Occasionally, a bank that was thought to be insolvent and the shareholders didn't have enough wealth to pay everybody could be run upon, but it didn't spread. So bank runs and panics were a problem in countries that had weak banks due to regulations that weakened banks, not in countries that allowed banks to fortify themselves like Canada and Scotland. So sunspot theory doesn't explain that difference. What's a better theory? Better theory is people run because they get some signal that tells them that the bank might be insolvent. And it doesn't have to be a perfect signal, but it has to have some information content. So runs occur when depositors get bad news that the bank might already be insolvent. And then they run because there's not enough to go around. That explains why runs and panics occur at the beginning of recessions. economic historian named Gary Gorton. Well, he used to be an economic historian. Later, he became an advisor to AIG. And after since AIG failed, he's been writing papers about how it wasn't his fault. There was a general market panic that he couldn't have anticipated. Anyway, back when he was a respectable economic historian, he looked at the panics in the US and said, well, here's a proxy. If you look at the rate of bankruptcy filings, you find that when it reaches a critical value, there's a panic. And when it doesn't reach that value, there's no panic. So what is that saying? People read the newspaper, they see the local industry is failing, they know the local bank, which is not well diversified geographically, is heavily lent to the local industry. Now the local bank's in trouble, so time to run the bank. And that also explains why you get geographic clusters of bank runs. If the two banks across the street are both lent to the same local industry, then if one's in trouble, the other's in trouble. So that's a better theory, but this debate is still with us. You get people bringing out the sunspot explanation in the exchange rate crises in Southeast Asia in the 1997, 1998. Right, the bad news theory is those governments signaled that they weren't going to maintain their exchange rate against the dollar, so better get your dollars now while you can before they devalue. The sunspot theory is it was just an irrational investor panic. If nobody had panicked, everything would have been fine. You hear it again, this debate, in the Bear Stearns and Lehman cases. So the sunspot theorists say there was no problem at Bear Stearns or Lehman except for the funders who didn't want to roll over their loans. So the way Bear Stearns and Lehman were being funded was not by deposits per se, but by overnight loans that were renewed every night. So very short-term deposits, the equivalent of. And if the funders decide not to lend tonight, that's the equivalent of withdrawing a deposit. So if everybody decides not to roll it over, that's like a bank run. So one theory is it was just herd behavior by the funders. Freddie Mac, by the way, lost $5 billion when Lehman failed to open on Monday. That's how much they had lent them overnight. The bad news theory is that people got a signal that these institutions were insolvent and decided not to keep rolling over their money. Oh, and by the way, they were insolvent, right? There's this very dramatic PBS Frontline special about these events, and just as kind of an aside, they mentioned that, right, they closed the bank over the weekend. They brought people in to examine the books, see if anybody wanted to buy Bear Stearns. Oh, by the way, they discovered it was insolvent. Well, then the people failing to continue to lend the money weren't being irrational, were they? Anyway, Diamond and Dybvig, as I mentioned, are associated with this. They formalized the theory in a very heavily cited paper. But it's actually an old idea. In a letter to one of his correspondents, Thomas Jefferson wrote in 1813, it is said that our paper currency is as good as silver because we may have silver for it at the bank where it issues. This is not true. 1, 2, or 3 persons might have it, but a general application would soon exhaust their vaults. Right? The banks don't have enough money in the vault to pay everybody. Nothing is necessary to affect it, that is this general application, a run, but a general alarm, and that may take place whenever the public shall begin to reflect on and perceive the impossibility that the banks should repay. So if people just were aware of the structure of the bank balance sheet, the bank could not survive. Banks are inherently fragile. The Diamond-Dybvig model has sort of virtues as a useful, tractable model, but it has these features which are kind of special. Runs are the only cause of bank failures in the model. They abstract from the problem of banks making bad investments. Deposit insurance is costless in the model. All you need is an agency that credibly promises that if anybody gets paid less than a full payout because other people have grabbed the money first, we will go in and redistribute the payouts so that everybody gets the same, thereby taking away the incentive to be first in line. So it's no longer a dominant strategy to run the bank. And because people believe that, nobody ever runs. And because nobody ever runs, the bank never fails. And therefore, the deposit insurance agency never has to make a payout. Right? But the bank is inherently fragile. And if you only looked at US history, you might think that was descriptively accurate or plausible. But if you look at banking history worldwide, you wouldn't believe that. And I mean, just think about it in kind of crude Darwinian terms. If banks were as fragile as the Diamond-Dybvig Bank, would banking have survived from its origins in Italy in 1200 AD up to the date at which deposit insurance was enacted? How did they survive if they were really that fragile? Well, if you look into the deposit contract, you can see how banks could fortify themselves. So it's rational to run your bank if you're entitled to a certain number of dollars. There's no condition on your withdrawing that money. It's unconditionally redeemable on demand, in which case the bank basically has to pay people first come, first serve. Diamond-Dybvig called this the sequential service constraint. And third, the last person in line isn't going to get paid, or is unlikely to get paid. You put those three things together and it's rational to run the bank. But it's the combination. So to stop runs or to make the bank less run prone, it only has to change any one of those three. Changing the first one, changing it from a debt claim, means it's no longer a bank, it's now a mutual fund. And you can have checkable money market mutual funds that are not run prone because they don't have a fixed share price. It's not exactly what we have today because we allow the mutual funds to fix the share price and carry the assets at their face value instead of at their current market value for regulatory reasons. But anyway, in principle, a mutual fund could provide you with a run-free checking account. What banks did historically was change the second and third conditions. They made withdrawals conditional. So an example would be a notice of withdrawal clause that the savings and loans in It's a Wonderful Life had. That was common, right? So it says, normally we will pay you on demand, but if too many people are asking us, we can put you off for 90 days. And in 90 days, we'll have enough time to liquidate enough assets without suffering fire sale losses. Some banks in Scotland actually put it on their banknotes. We will pay you on demand or at our option in 6 months' time. And you might think, why didn't they always invoke that clause? And the answer is, there's more to it. It said, in that event, we'll pay you interest. So that made it incentive compatible. The bank did not want to invoke the delay because then it turned it into an interest-bearing liability. And so they never did invoke it unless they were subject to a run. Or, yeah. Well, those clauses were outlawed in Scotland. That was one of the restrictions that Adam Smith supported. The other one was a minimum banknote size. But they were important for US thrift institutions. The thing that was most important to secure banks against insolvency, to secure them against runs, given that people ran when they thought a bank was insolvent, was to assure people the bank wasn't insolvent. So how do you do that? How do you assure people that you're not going to be unable to pay them? Well, you have adequate capital, and you advertise the fact that you have adequate capital. So before deposit insurance, banks had about 20% capital on average. And it wasn't a secret. If I had my PowerPoint show, I've got pictures of bank advertisements, and the top item is, this is how much capital we have. Bring your money here. Banks used to paint it in the window of the bank in gold paint. This bank has $2 million capital. When the FDIC comes along, they scrape that out and put in a sticker, protected by the FDIC. That's all you need to know. Now, how much capital is adequate depends on how safe the assets are, right? How big the threat to the capital is. So banks, as I mentioned before, held much safer asset portfolios. They avoided interest rate risk by not having long duration assets. They avoided default risk. They avoided liquidity risk by having assets that they could sell quickly. So the main asset that commercial banks had was commercial paper, short-term business IOUs that had a secondary market. A third way banks could reassure people against thinking they wouldn't get paid is, of course, extended liability, which I mentioned. I'm working on a paper with a couple of students now about whether it would be desirable to reintroduce extended liability in the US, not to reassure depositors, but if we don't remove deposit insurance, it's a way of giving the shareholders something to lose. And the problem with deposit insurance today is the shareholders don't have enough to lose because the depositors aren't paying attention. Last thing that banks in the US did was they joined clearinghouse associations, initially just to have a convenient way to clear checks and banknotes. But the clearinghouses learned, you remember the famous Groucho Marx aphorism, I wouldn't want to be a member of a club that would have me as a member. A bank wouldn't want to be a member of a clearinghouse that would let just anybody join. You only want other banks in the clearinghouse that are going to pay you at the end of the day, because you're accepting their checks during the day. You want to get paid at the end of the day. So clearinghouses began to have minimum capital requirements to be a member of the clearinghouse. Then they discovered they need to actually enforce those. So banks had to submit their balance sheets. And then that wasn't enough. Banks actually began to send auditors, sorry, the clearinghouse began to send auditors into the member banks to make sure they really had the net worth that they were claiming to have. So the first bank auditors or examiners were not federal employees. They were private clearinghouse employees. Right? So it's a remarkable degree of self-regulation. And they were trained by the clearinghouse. Your job is to tell the clearinghouse association whether the bank is solvent, but you're not supposed to tell the other banks what their business strategy is. You're not supposed to reveal who their clients are or what their deals are like. Right. So banking panics are a problem in the US. They're not a problem in countries that don't have the same legal restrictions on banks that the US has. Scotland, Canada, Sweden, Switzerland, etc. Okay, so this is all a way of arguing that the run and panic quelling benefit attributed to deposit insurance is really less than estimated if you consider the alternative, not the US system, weak as it is without deposit insurance, but a system that's not so weak. There's no movement for deposit insurance in Canada because there's no problem of runs and panics. So if we had had a Canadian-style system, we wouldn't have needed deposit insurance. Now, if deposit insurance were costless, then it wouldn't matter that the benefit is small as long as it's positive. But I also want to argue that the cost is greater than advertised. I mentioned that in the Diamond-Dybvig theory, it's costless because the only cause of bank failures is runs. But in the real world, the main cause of bank failures is bad loan portfolios. And the cost of deposit insurance is that somebody else foots the bill when a bank fails because it's invested badly. Now, you might ask, don't banks bear the expense? Right? Isn't the FDIC funded by assessments on banks? And the answer is yes, normally when there's no problem in the banking industry. But when there's a big cluster of bank failures, as in the savings and loan crisis, as in the commercial banking system in 1991, as in the commercial banking system since 2008, it's taxpayers who end up footing the bill, right? The way the savings and loans depositors were paid was that money was borrowed from the US Treasury, which means taxpayers were on the hook for it. The FDIC's bank insurance fund is currently in the red. Nobody notices. In 1991, when the FDIC ran out of money and got a $90 billion credit line from the Treasury, that was big news. And it was such big news that I helped organize a conference, and Maria mentioned the title of the book, The Crisis in American Banking, because it looked like it was going the same way that the FSLIC had gone. So the conference was in 1991, the book wasn't published till 1993, and by then the crisis was over. So the book never sold very well. I think NYU Press still has copies. I was hoping when the book came out that maybe Citibank will fail and then we can sell some copies, but it didn't happen because reasons I don't need to go into. Anyway, so today it's you and I who are backstopping the FDIC. So let's talk about the dangers and costs of deposit insurance today. And the authority that I'm going to draw on the most is Edward J. Kane of Boston College, who became famous in the 80s for predicting the FSLIC crisis. He published a book in 1985 called The Coming Crisis in Federal Deposit Insurance. There are some patches in the Dodd-Frank Act, but we still have too big to fail policies. We still have regulatory capture. The regulators, of course, won't tell you that they've been captured, and the too big to fail institutions won't tell you that they've captured the regulators, meaning the Federal Reserve Bank of New York, the FDIC. Instead, the regulators pretend to restrict the banks very sternly, and the banks complain that they're being, you're twisting my arm. But really, together, the regulators and the too big to fail institutions are milking the taxpayers. They agreed to policies that shift risk to taxpayers, because that's who backstops the too big to fail policies. So here's the way Keynes puts it. Regulatory and banking cultures continue to encourage the country's largest, meaning too big to fail, banks to take on too high a risk of ruin, too much tail risk. They encourage a, quote, process of subsidy extraction, unquote. The central problem is simple. Safety nets encourage unhealthy relationships between banks and their regulators and distort the incentives of both groups. So this is exemplified by the Federal Reserve Bank of New York. It's empowered to bail out money center banks, but it has money center banks on its board of directors. So there are conflict of interest problems here, governance problems. There's a study by the General Accounting Office going into the details of what happened during the financial crisis, but Google the name Stephen Friedman. He kind of personifies it. He was a Goldman Sachs shareholder. I know Goldman Sachs has been good to Syracuse, so I'm not indicting Goldman Sachs, but he was a Goldman Sachs shareholder who was on the Federal Reserve Bank of New York board while it was deciding on loans, bailouts, how much AIG would pay Goldman Sachs, things like that. Now, it was kind of a fluke. He got on the board because Goldman Sachs was not a commercial bank at the time. It was an investment bank. But even after Goldman Sachs was given a commercial bank charter so it would qualify for TARP, he didn't resign. More recently, we've had this, about 6 months ago, we had the story of Carmen Segarra. I don't know if you remember that. She was a New York Fed regulator who was embedded in Goldman Sachs. So she had a desk at Goldman Sachs. She was fired for trying to be too strict, for questioning a deal that they were making as sort of not being properly accounted for in the impact on the bank's risk. So she was fired. But she had taped some of her conversations. So this was kind of a scandal, but it seems to have been forgotten largely. Here's another item. We learned after the financial crisis and after the audits, this didn't come out in the partial audit of the Fed, we learned that the Federal Reserve Bank of New York had secret lines of credit ready for Citibank and Bank of America. We only learned this because Bloomberg News filed a Freedom of Information Act request, and they had to divulge that. So here's the problem. Safety nets can cause financial fragility because they subsidize risk-taking. And the way Keynes puts it, they create strong incentives for managers to seek out unsupervised risks, to search them out proudly and exploit them aggressively in hard-to-monitor ways, putting taxpayer funds at risk. And in fact, that's the profit-maximizing strategy, to use your option to the hilt. Hence, going back to the quote, although financial safety nets exist ostensibly to lessen the potential for massive losses by the public from widespread institutional failure, they are used and abused by savvy banks and other financial managers to extract subsidies in ways that are hard to see and hard to stop, unquote. All right, and you can see why regulators are reluctant to close Citibank and Bank of America. By the way, they were supposed to intervene well before they approached zero net worth. There was a law passed after the savings and loan crisis the Federal Institutions Regulatory Reform and Enforcement Act, FERREA, of 1991, which said there's supposed to be early intervention. If a bank's capital becomes below 6%, then we suspend dividend payments, and if it goes below 4%, we fire the board of directors. None of that was done in 2008, completely ignored. So we have conflicted incentives by the safety fund managers, partly because of the revolving door between the regulators and the industry. They have incentives to go easy. And so we don't even have an estimate of what the sort of present value of the subsidies are from the safety net. And the way Kane sort of formalizes it or crystallizes this is to say, really, taxpayers have become equity holders involuntarily. They become equity holders in the too big to fail institutions because they're on the hook if they become insolvent. And yet the taxpayers are not consulted about the management strategy of the bank or the risks the bank is taking. So that's a problem. Now, let me say one more thing before I wrap up, which is if you sort of step back and ask what kind of banking culture we have, or what kind of banking environment we have, I guess that's what I want to say. Regulation has done a lot to homogenize banks. And since the financial crisis, of course, they've become a lot larger. There's been a lot of consolidation through acquisitions. The more rules there are to govern banks, the more alike banks become because they all have to follow the same rules. And that's a problem because instead of having a diversified ecosystem, we have a monoculture. And monocultures are subject to a single disease wiping everybody out. And in banking, we have a safety net, but the safety net has loopholes, right? The regulators can't find every risk the bank is taking in real time because the bankers are one step ahead of them. So they're looking for loopholes. And if they all discover a loophole at the same time, then you've got lots of banks over-investing in, say, mortgage-backed securities. And when mortgage-backed securities go down the tubes, then the banks have a big problem. Lots of banks have a problem, not just one or two banks. So we have a systemic problem. All right, so what we would like is a system that's not subject to catastrophe that way. And this way of putting it may sound familiar to you if you've read the works of Nassim Taleb. When he talks about fragility and anti-fragility, we have a fragile banking system, whereas we should want to have a banking system that gets stronger after shocks, like I said the Scottish system did after the Air Bank failure. A system that relies on bailouts is not an anti-fragile banking system, it's a fragile banking system. So in the long run, the problem is our too big to fail policies and deposit insurance have fostered moral hazard and contributed to fragility. Am I saying that we should have let Lehman Brothers fail? I'm saying we should have let large banks fail much sooner. If we had done that, if we had let even Bear Stearns fail, Lehman Brothers would have been less of a problem. So the challenge that faces us is developing a way to credibly tie the hands of the safety net regulators, assuming we continue to have the safety net, not to bail out insolvent institutions. And stepping back to a sort of meta level, the issue here is having the rule of law in our banking system and not ruled by authorities who get to make up the rules as they go along. If you read sort of classic sources on the rule of law like David Hume, he says, yeah, there are going to be cases where it's inconvenient to stick to the rule of law. There are going to be people who it's very painful to if you don't rescue them, but in the long run, we should venerate our ancestors who came up with this principle because there's less inconvenience in general to everyone in the long run if we adhere to the rule of law. So I have a paper entitled Rule of Law or Rule of Central Bankers, sort of goes into this sort of meta issue. So I think that clearly puts too big to fail under question. lots of people question too big to fail. I think it also puts deposit insurance under question. And Kane and some co-authors have a study looking across countries, because deposit insurance has spread from the US to the rest of the world, asking, has it been an improvement in banking systems around the world? And the answer is, in countries that they characterize as having poor contracting environments, so basically less developed countries where the rule of law is poor and therefore there's a lot of cronyism, it's actually made the banking systems worse, because it's reduced depositor scrutiny of banks and therefore encouraged risk-taking. It's fostered imprudent banking practices. Whereas in countries with good rule of law, it really hasn't made a difference. Right? It's eliminated the old-fashioned panics, but it's created the offsetting problem of too much risk-taking by banks. So to end on a positive note, what I'd like to see, we should have an environment that allows and encourages banks, banking entrepreneurs, I was told to mention the word entrepreneur, to introduce new services without having to double check with regulators first, not to spend their time looking for new loopholes. If we block that kind of discovery, as Israel Kirzner, the theorist of entrepreneurship, reminds us, we're losing out on improvements in consumer satisfaction that we could have, but we don't even know what we're losing out on because we blocked the discovery. So we should rely a lot less on one practice fits all common restrictions and safety net protections on banks. We should rely more on the market's mixture of you're free to innovate, but there's strict discipline. If your innovation succeeds, you keep the profits, but if it fails, if the bank fails, you bear the losses, not somebody else. So my mantra is let 1,000 banking models bloom, but don't artificially preserve any of them. Thank you. I'll take questions in case I've said anything controversial.
Great, I think we have time for a few questions, and Tom, would you with the microphone?
Sure.
So over the past few weeks, there have been a number of reforms proposed to change how the Federal Reserve is structured. So for example, John Deere, the Vice President of the Financial Services Forum, suggested redrawing districts, or at least adding more districts out west.
Yeah.
Given that, I think your proposal would probably be to end the Fed altogether. Correct me if I'm wrong.
Once we're ready to, yeah.
Sure. So it seems like that's probably not on the table in the near future. So I'm wondering what suggestions you would make for changing how the Fed is structured or operates now to, I guess, make it more in your image while acknowledging the fact that the entity itself is probably here to stay.
Yeah, so the fact that the Fed map hasn't been redrawn since 1914 is indicative of sort of how much status quo bias there is in the Fed, because somebody's turf would be reduced if somebody else's turf were enlarged. But yeah, the population has moved west to where like 1/3 of the population is in the San Francisco district. So it would make sense to redraw the map. I don't have any objection to that. The reform that concerns me, or the change that concerns me about the structure of the Fed, is some people have proposed taking the presidents of the regional reserve banks off of the Federal Open Market Committee, which decides monetary policy. And the reason that concerns me is the other voters on the FOMC are political appointees. The presidents of the regional reserve banks represent banker interests, and the bankers have the right interests in this case, which is, as in the savings and loan crisis, bankers get hammered when inflation and interest rates go up. So they are inflation hawks. And they have a more credible commitment, which we know from the theory of time inconsistency, it's good to have a credible commitment. There's nothing to be gained from having the public worry about how much inflation you're going to allow. So the Federal Reserve regional bank presidents have a better voting record, from my point of view, than the Board of Governors. So I would hate to see them taken off. Now, the conflict of interest problem that you see at the New York Fed, mostly because that's where the big banks are, is having the regional reserve bank presidents on the Board of Governors is a monetary policy matter. The conflict of interest is when we let them in on bank regulatory policy, and they're close to the banks in their region. that's a problem. So it's okay having autonomous regional banks for the purpose of executing policies that are decided on a national basis and not on a regional basis. But to have policies decided on a regional basis is a problem. I asked my friends at the Federal Reserve Bank when all these bailouts were announced, AIG, Bear Stearns, who's calling the shots here? Is it the New York Fed or is it the Board of Governors? And they said it's the New York Fed. The Board of Governors defers to them on those kind of questions. Other kind of, if you look at the structural reform, so just to back that up, if you look at the history of the Bundesbank, they had a lot of banker involvement on the board and they had the best inflation track record. Swiss National Bank, same thing. When it comes to regulatory policy, of course it's not just the Fed. It's also the FDIC and it's also the Office of the Comptroller of the Currency. So there were proposals under the Bush 41 administration to consolidate all the bank regulation in one agency. And that has pluses and minuses. On the one hand, banks could escape from regulations that were inefficient to a different regulator who was allowing them to do efficient things. On the other hand, they might be able to escape restrictions on their ability to exploit the safety net. And so I have likewise been sort of ambivalent about the partial repeal of Glass-Steagall because there are safety net spillovers. That there were supposed to be firewalls to prevent that, but turned out they were breached rather easily. Yeah, so it's changing. I don't really see much of a connection between changing the structure of the Fed and changing bank regulation. We did have a structural change in Dodd-Frank, which was we embedded in the Fed the Consumer Protection Agency. And it was mandated that its budget doesn't come from Congress, it comes from the Fed, which is pretty weird, which means that it's harder for Congress to review its budget and whether the program is creating benefits in excess of its costs. So I wasn't keen on that one.
I think they did that because Congress would try to defund
so it was a Democratic
over.
Congress anticipating a Republican Congress trying to defund it. Yeah.
But I was just gonna ask you about. I believe I don't know if I misunderstood you, but you espouse like Laissez, Faire banking. Well, so as the system that we have today, taxpayers and the government backs the banks.
Right.
Lending. So it will be, I would think, impossible to not have the government and the public have a say when if the banks fail, like they do almost every 10 years or whatever, due to the crisis in capitalism, not have the taxpayers have a say, or basically have the government get out of there and not back the banks. Otherwise, so what would you say against that argument?
So, yeah, what I'm suggesting is not that we should keep the backstopping of banks by taxpayers and then let the banks do whatever they please, right? That creates huge moral hazard. That creates a huge contingent liability for taxpayers. That creates all kinds of bad incentives, and that leads to occasional calamities like we had in the mortgage crisis, the 2007, 2008, the panic of 2007. So that's what we want to get away from. And today that principally means taking away the taxpayer backing of banks so that banks will behave more responsibly, so that taxpayers aren't guaranteeing their losses. If we don't do that, if we continue to have too big to fail, we continue to have deposit insurance, then we get into a world of second best. So how can we limit the bank's ability to exploit the subsidy they're being given to take risks? And trying to say, okay, we saw banks taking risks in this way, investing in mortgages, we're going to put a limit on that. We saw them investing too much in less developed country loans, that was a previous credit problem. We're going to restrict that. If you do it activity by activity, it's like trying to squeeze a balloon to reduce its volume. You just push it somewhere else. So my view is if we want to take away excessive risk-taking, we have to take away the incentive, which is created by having this system where they get to keep the gains, but they socialize the losses. All right?
Just quickly.
Yeah.
Just quickly. So the banking system has gotten to what it is today. It's too big to fail due to it has become unsustainable. We can agree to that.
Okay.
And it has become sustainable because banking is not doing what banking was meant to do when it was invented, which was to lend people so they could create businesses and that way grow the economy. Now it's just basically gambling, if you can put it that way, to put it bluntly.
At the margin, that's right.
So,
too much gambling.
So the gambling that's going on Wall Street or in London, which has created most of the economic growth, is now based on physical realities. And since the gold standard was taken away in 1970s, now they can just basically grow forever according to their thinking without any consequences. So what do you think about this when it comes, if you want to relate it to equilibrium and economic theory?
Yeah, so we do have too much bank gambling. It's not that that's all that they do, but too much at the margin. I think if we sort of look at banking systems around the world that have had smaller problems, we might have something to learn. If we look at Canada, which went through the crisis pretty well, if we look at Switzerland, even if we look at offshore banking, which didn't have a problem in 2007. And we find there that the banks had better incentives not to gamble, not so much that the regulators were on top of things restricting the risks that banks were allowed to take. But I agree with you. I mean, the function of the banking system has been distorted by changing the incentives that banks face, and principally by not making the losses come to visit the bankers that suffer them by taking unreasonable risks. So that's what we need to fix.
Looking into the CCAR or capital adequacy space, by further restricting or elevating capital levels, do you feel that those requirements are diminishing short-term liquidity needs? You touched briefly upon this in reference to the Lehman Brothers and the overnight repurchase agreement environment.
Okay, so people have recognized that banks have too little to lose. They're too thinly capitalized. And there's been a series of agreements on capital adequacy, raising it and trying to graduate it according to the risk the bank is undertaking. And we've had this series of Basel agreements. And let me talk about those before I get to your question about liquidity. And so the Basel is this result of a sort of bureaucratic compromise among central bankers. We're going to all have the same capital requirements so that banks don't shop around for a venue where they can operate with less restriction. So it's kind of a non-competition agreement among the regulators. And then in the first round, they tried to assign risk weights to capital, to different kinds of investments. And banks looked at those weights and said, okay, we can figure out which ones are overweighted and which ones are underweighted, and we're going to pile into the investments where the risk is underweighted. Namely, in particular, they put a zero weight on sovereign debt. So banks in France and Germany pile up on Greek government debt, and they don't have to hold any capital to absorb losses on that, because there aren't going to be any losses, ha-ha. So they went back to the drawing board and came up with Basel II, and banks learned to game that, and they went back to Basel III. But the banks have, more resources and more incentive to find the loopholes. They're never going to be possible to close all the loopholes. So we had so actually this refers back to the last question. We have this weird situation today where bankers in the US are being told by their regulators, we don't want you to do so much lending to businesses because that's risky, and we're going to raise your capital requirement if you do that. And in a way, they're incentivizing banks just to buy government bonds and to sit on excess reserves. And so we've had a huge growth in bank reserves and very little growth in business lending. Now, I'm not sure I got exactly to the nuts and bolts of your question, but and that's how I understand that's the complaint bankers are making, that we're being told, although the Fed is saying we're trying to spark recovery by encouraging business lending, the regulators who visit our bank are saying, don't do too much business lending, stay safe. They're sort of overreacting to the last crisis. Yeah.
I had a question relating to eliminating FDIC insurance.
Yeah.
So if we eliminated FDIC insurance, would
Yeah.
we remove money from the system? And the reason I say that is if I were an artist and I have absolutely no financial knowledge whatsoever, no interest, and I had to make an informed decision about whether I want to put my money into the bank,
Yeah.
why would I put it in the bank if there's no protection offered? And I'm scared. You know, I don't know whether my money's going to be there without that insurance protection.
Okay, so I mean, that's a good question. So the question is basically, do we shrink the entire financial intermediation system if we take away guarantees? Well, that would make for an interesting historical study. I mean, we could look before and after deposit insurance. My impression is it hasn't made a big difference. It's not that the banking sector grew compared to its historical trend, but I haven't done that study. It helped get the money back out from under the mattresses where it had gone during the banking panics, but I don't think it attracted any money that had been on the sidelines because people couldn't find a bank that they trusted. It's true that in the absence of the FDIC sticker, the depositor would have to do a little bit of research. Right? They'd have to go online and see who are the healthy banks before they decided where to put their money. Just as they do when they decide to put money in a mutual fund, or if you're serious about it, when you decide to buy insurance, you really ought to go online and see what the credit rating of your insurance company is to make sure that they're going to be there when they have to pay you. So it is possible that that would discourage some people from keeping money in banks, but it's going to be giving the banks an incentive to convince you that they are safe. Right? So they have to be more transparent, and they have to have some kind of credible certification that they're solvent. And banks tried to do that in the days before deposit insurance.
If I may be allowed to
Yeah.
comment on that. If I buy a toaster, I buy a GE toaster, I buy it from Macy's, and it's got a UL sticker on it, Underwriter's Limited sticker. So I got a threefold assurance that when I take it home and plug it in, it's not going to blow up on me. So these kinds of branding and seal of approval type mechanisms are totally out there in the market.
So you got the banks.
I go to Walmart and get a Walmart approved bank account.
So you've got the bank's brand name, and you've got the clearinghouse certifying that the bank is solvent, and they should know. What is true is that there's nobody saying we're going to pay you back no matter what the bank does. But that has healthy incentive effects on the bank's behavior.
Yeah. This kind of goes along with that, but so the vast majority of regulation on banks is not made public. Would you recommend the findings that regulators are coming up with or the conclusions to be made public so that the average consumer is more aware of what's going on within the institution?
I'm not quite sure what you mean by saying it's not public. I mean, the Fed has a long catalog of rules that you can read online.
Oh, no, I'm sorry, not the rules, but the individual institutions.
Oh, right.
Whatever the OCC or the FDIC come up with, it's still not made public to the general
Right, so
audience.
the bank ratings are not made public for obvious reasons. They're worried that the uninsured depositors are going to flee the low-rated banks, but maybe that's more discipline. Maybe that's a good thing because they're going to put money in the highly rated banks. It's not going to be lost to the system. Yeah, I'm not sure about whether the ratings ought to be public. When the private clearinghouses did the inspections, what they announced was either the bank is solvent, we stand behind it, or the bank wasn't solvent, but they've agreed to put up more capital and we're standing behind it in the interim, or they haven't agreed to our terms and we've kicked them out. So that was enough for the public to know sort of whether they were standing behind the bank. Sort of more fine-grained what the regulators found, what the auditors found. You can see why they wouldn't want to announce that.
I guess my personal experience has been that my experience with the bank is more based upon the service or the experience
Sure.
in working with them, and not on their financial stability.
Mm-hmm.
The fact is, I don't even know what the financial stability is of my institution. I've been with them for a number of years. I would never think of really doing the research into it.
Aren't there consumer places that rate banks on consumer service? It doesn't have to be the OCC or the Fed that does that.
I guess my thought was that most people wouldn't really know where to begin with analyzing a bank's financials or what's going on here. And it would be
Right.
much more of character, much more of the experience with the institution.
Well, they need to know whose ranking of the institution they can trust. All right, so the Underwriters Laboratory does that for electric appliances, and the clearinghouses did that for commercial banks.
We thought we could trust rating agencies, and that proved to be.
Well, we had a kind of pseudo market in rating agencies, yeah, so that's a whole nother story. But we created a kind of cartel by giving the ratings regulatory force. So you had to go to one of these three agencies to get a rating that would then determine what the regulators decided was your capital requirement. So that gave them a captive business.
In the absence of the protections, though, I mean, banks are still businesses. Their incentives are to make money.
Sure.
And, I mean, with no one looking into what they're doing, I would think there would be a lot of banks saying, like, oh, yeah, we have 20% Tier 1 capital, Tier 1 leverage, and, you know, people wouldn't know how to verify that.
Right, so what you want to make sure is that your bank is a member of a clearinghouse that's verifying that. And if it's not, then it's going to have a hard time, you know, providing you with payment services, because it's going to be more expensive to clear your checks if they have to hire some other bank to do it for them. And the clearinghouse is going to make that other bank responsible for your bank actually meeting its obligations. So they're going to send auditors into your bank.
Would not the industry shrink considerably, because like a handful of banks would get a reputation for being really good, and then a bunch of other ones?
Well, I don't think the historical record shows that.
Doesn't Canada have like five-ish really big banks?
Canada has a smaller number of banks than the U.S., that's right. And that's because they always allowed nationwide branch banking, whereas the U.S. had an artificially high number of banks because we had these restrictions on branching. And we're moving in that direction. I'm not sure about the four-firm concentration ratio in the U.S. might actually be as high as Canada's right now. The practical question is, are the Canadian banks competing with each other? And the way to measure that is, how much are they paying on deposits compared to what they're charging on loans? And the answer is, they are as competitive as the U.S. banking system.
Larry, we have time for one more question.
Okay, this is a different. Thank you very much for a very interesting presentation. Do you consider the use of Bitcoin as an example of an aspect of free banking?
Well, not one that I had thought about before it happened, but in a broader sense, yeah, I think it's great to have people come up with this. I don't quite understand why it has a positive value, but it does. And so it potentially could become a widely used method of payment. And I think it should be free to do so. So I don't think there should be laws blocking it. The people trying to promote it, though, are facing problems now that the authorities are demanding that that Bitcoin payment processors follow all the rules that banks face with regard to knowing your customer. And that's a huge burden, right? So you have to be licensed as a money transmitter and you have to know your customer. And that's going to quash these kind of developments. And a lot of that has come since 9/11 because we discovered that the guys who hijacked the planes, they got their money from the home country transmitted to them through Western Union. So everybody else who were informal money transmitting services now had to follow the regulations that Western Union faces in order to fight terrorism.
One quick question.
Yeah, the first question is, the first part of the question, were there any banking financial crisis from 1950 to 1980s during that time period? Because you talked a lot about 81.
That was a pretty calm period.
Okay, and did you have FDIC during that period?
Sure.
So why were there no crisis at that point and only after 1980?
Well, it is kind of a puzzle.
Wait, but there was the banking crisis there in the 1970s when they had to get rid of the gold standard.
Well, that was a monetary policy crisis. There was Regulation Q, which was sort of keeping banking profitable. There were entry restrictions. And so it was not very good for consumers in terms of the returns they were getting on their bank accounts. It's kind of like if everybody drives a tank, then nobody dies in car accidents. So in a sense, the system was sort of too armor-plated, I guess would be my diagnosis of it. So it is possible to veer in the other direction. But monetary policy was very stable. Well, 1980 is too late an endpoint because there is a crisis by 1980 in disintermediation from the banking system when Regulation Q began to bind them. When inflation rates went up in the 70s, lots of money flowed out of banks because they weren't paying competitive returns. So that was a crisis. But if you just look at the 20 years where monetary policy was pretty good, then the environment was stable. I guess banks hadn't discovered quite how to exploit the safety net as well as they have now.
So is it possible that the increased use of stock options from the 80s led to more upside gains but no downside risks? It's not the FDIC downside risk, but another instrument that caused banking bad behavior.
While we have a safety net, there is a case for limiting the compensation schemes that the top bank management has so that they don't game the system. But I would prefer not to intervene into how banks pay people, but that means take away the safety net guarantees.
Thank you all for being here today. We really appreciate it. Larry, thank you so much for this interesting presentation. Hope you all have a great rest of the day.